All right, it looks like we're right on time here. So we do have some folks still joining, but to stay on schedule, let's go ahead and kick things off here. So my name is Jamie Terrell, and I lead the marketing and communications here at Saltmarsh, Cleveland & Gunn, and we are so happy to have you here with us this afternoon. If you have joined our weekly webinars previously, welcome back. If you're here with us for the first time today, I'd also like to give you a warm welcome. We appreciate you taking the time to be here with us today. As you may already know, our firm has been closely following all things COVID-19, and especially the developments related to the Paycheck Protection Program, more commonly known as the PPP. In fact, we have developed our own COVID recovery and response team, which represents key leadership with varied backgrounds from within our firm. And they've been following this really daily, interpreting the different guidance that's been released. And so here with us again are three members of that team. We have Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh. They are once again coming to you live from their at-home work environments, and we are glad to have them leading our presentation today. Glenn, we appreciate you making your bed for us. Thank you.
No problem.
If you participated in our PPP webinar just 2 weeks ago, you'll remember that at that time, we had many unanswered questions. And now here we are 2 weeks later. While we still don't have answers to all of our questions, we have received more guidance, so that is good news. So we're here today to share what we know, and in full disclosure, the things that we still don't know, and guidance that we still have not received. But we will continue to hold these sessions for you as new guidance does come out. We are committed to helping you navigate and understand these impacts. We think that that is very important. So before we begin, I do have just a few quick housekeeping items. Everyone on the line is muted. Since we do have a large group, we want to make sure that this is a smooth experience for everyone. So if you do have questions during the presentation, feel free to share them with me in the chat, and I'll hang on to those for our Q&A at the end. In the interest of time and our broad audience, we will hold all of your specific questions related to personal circumstances and scenarios, and we'll arrange for someone to follow up with you offline. We have received many specific questions, and I think it's fair to say that a lot of this is going to be very circumstantial, so we want to make certain that we're giving you answers that fit your certain situations and your needs as well. So you're also welcome to share your questions with us by email, and that would be sent to ppp@saltmarshcpa.com. We'll share that email with you a little bit later on as well. Today's presentation is being recorded, and you'll receive it tomorrow by email along with a copy of our slide deck. In that same email, you'll see a link to complete a short survey. It should take less than a minute, and we really do appreciate that feedback. These webinars are fairly new to us, and so if this is a platform that you enjoy, we want to know that so we can keep bringing these to you. So with that, I will go ahead and kick it over to Suzanne Cox, shareholder in our audit and assurance practice, to get us started. Suzanne?
Thanks, Jamie. And this time we will actually record it. I know we had some issues on the first one, so we apologize for those of you that requested it. This time, as Jamie said, was a new platform for us. I think we're going to have the recording on point this time. So welcome back to those of you that were here for the last one, and hello to everyone else. As you can see, it is still May of 2020. I know it feels like a long time has passed since our last webinar, but it is in fact still May. Our intent today, we're going to walk through the forgiveness application for a hypothetical company. It will be woven into our presentation, so that won't be the entire presentation. We will be going over, as you can see, the most current guidance, what is allowable, what are the limitations on forgiveness, and how to properly document your expenses. As Jamie mentioned, there still is quite a bit of information, very specific information that we don't know, but we got some very good feedback from the first session that you all enjoyed when we said, hey, we know this, or hey, we don't know this. So we will continue to tell you, hey, we're not sure about this, but we will tell you what we are sure about, and that has gone up quite a bit. We do know a lot more at this webinar than we did at the last one. And then at the end, we're going to go over some frequently asked questions. And as Jamie mentioned, you'll have an opportunity to add yours to chat. We won't be going into super detail, but we can cover some highlights. So one of the biggest questions that we're all getting is, the big accrual versus cash question. What are they gonna do it on? And the answer, not to confuse anyone, is both. So that we'll get into some further detail, and we'll have some examples here. But if you're an accountant, put away your textbooks. You're not going to like this. For the rest of you, this will probably make a lot of sense. So we'll get into some more specifics. But as you can see, the language for the interim final guidance is that if it is paid or incurred. And I know there's a lot of questions out there. People are saying different things and interpreting it differently. But it is very clear that it says or, and the SBA has issued examples. And so we've used those examples and used our sample company, and we're going to give you a couple of those so you'll see how to do that. So our subject today, a shout out to our Canadian friends, Do Right Services Inc. And you can see a little bit about the company here. We're not going to, you don't have to remember this, you don't have to write this down. We will reiterate some of this as we go, but just, top level, they got a PPP loan for $250,000, and their loan was funded on May 15th, which means their covered period is May 15th to July 9th. That is 56 days and 8 weeks. So that is the only information that's real important, is their covered period. And we'll go into that a little bit more. Do Right had an average utility bill of $500 a month. And as you can see here, they have a mortgage. They're paying $750 a month in interest, and they have 2 truck leases. So not a lot going on. We picked a simple company for the sake of a webinar, and we'll get right into it here. All right, one thing to remember as we start walking through this application, this is just a little snip of page 1. Just keep in mind that this application and this webinar is going to be a little technical. So everyone get out their caffeine, pop some, whatever you need to do to stay awake. Hopefully we'll make it as interesting as possible, but just remember that we are here to help you. So if you get into this process and you start filling out this application, or right now your eyes are, rolling back in your head, just keep in mind that we are here for you. We're going to offer several levels of service, to help you with this application, whether it's just review or actually fill it out for you, or just answer questions. So keep that in mind. If you're getting lost, we understand that it is very technical, and we are here to help. So this is page 1, little snippet of page 1. The most important thing here is that the employees at the time of loan application, as you can see, that is not the FTE calculation, that is actual employee count. The other thing here to note, the EIDL advance amount, that is if you received EIDL funds, you got $1,000 per employee. If you got that $10,000 grant, that needs to go in this line here along with your application number. So that amount will be reduced from your PPP loan forgiveness amount. Another thing to note, we have had this question quite a bit, is the application the same for sole proprietors and corporations? And it is in fact the same. So if you are a sole proprietor or a corporation, you will be following the same application. All right, so I think this slide, I'm going to pop it over to Andrew.
Yeah, thanks, Suzanne, and good afternoon to everybody out there on the interwebs today. Happy to have you with us and glad you're here. So this slide, we begin to kind of, as we work down through the PPP loan forgiveness application, the very first line 1, appropriately numbered, is your payroll cost. Now, the payroll cost, the actual calculations are handled in a separate schedule, which really gets into the weeds, and we're going to talk about that schedule, but we're not going to get into the actual calculations in too great a detail on that schedule. It would take way more time than we have today and really truly put everybody to sleep. But a couple important things to remember about your payroll costs. You're allowed to calculate your payroll over 2 different periods. one of two different periods. You have to select one or the other. The first is what is called the standard calculation period, and that's payroll that is paid or incurred during the covered period. And remember, the covered period starts on the first day the loan is dispersed. So in this example, in our example with Do Right Services, that's May 15th through July 9th. Employers who have, and this is a key distinction, who pay biweekly or more frequently than biweekly, which for most people would be either biweekly or weekly, are allowed to select an alternate period. And the alternate period begins with the date of the first payroll cycle following your loan disbursement date. So in our example, we've created a situation where Do Right's first payroll begins May 21st. Their first pay period after the loan is dispersed begins on May 21st. And so they would be allowed to use an 8-week period beginning May 21st and running through July 15th. So once again, that alternate period is only available to those who pay biweekly or more. So if you pay, for example, twice a month, you don't have the ability to select the alternate payroll period. It has to be biweekly or weekly. So Suzanne, Glenn?
Andrew, just to point out also is that this alternate payroll period is only applicable to the payroll costs and not the other costs that we talk about, the non-payroll costs. So the non-payroll costs are still under the May 15th through July 9th.
Yeah, that's a great thing to point out, Glenn. Thanks. And that is important. We try to point that out on later slides, but Glenn's absolutely right. It's only payroll that you get to select this alternate period for. So, all right, Suzanne, next slide. So just a couple of examples to show you how this works. So once again, we've kind of scheduled out some pay schedule, a pay schedule for our little subject company here that's listed on the left. You have pay period that began on May 7th and ended on the 20th. That's a Thursday through Wednesday, 2-week period, and then paid on Friday, which is 5/22. And we've listed that out. And you'll see what you see here is using the covered period. Remember, our covered period begins 5/15. So you're allowed to count the payroll that is paid on 5/22, even though only a portion of that payroll was actually incurred during the period that began on 5/15. So because that whole 27,262 in this example was paid, you get to include that entire payroll. Then you get to include the payroll that was paid on 6/5, the payroll that's paid on 6/19, the payroll that's paid on 7/3, and then when we get down to that last payroll, you're allowed to include the pay that is incurred before the end of the period. So here, that pay period runs from 7/2 to 7/15. You're allowed to include the pay that is incurred through 7/9. And so in this example, we're assuming a 5-day work week. There are 6 work days between 7/2 and 7/9. And so you would be able to take 6/10 or 60% of that 36,923.04. So using the covered period in this example, the employer would be able to seek forgiveness for roughly $172,000 in payroll. A couple key things about this schedule just before we go on. You'll notice that we have this schedule, pay is kind of increasing through the 4th pay period. That's because we baked in some assumptions that maybe the employer furloughed some people and is having to hire people back during this period. You'll know that the last payroll decreases by about $10,000. That's because once you start to get into that 5th payroll period here, you're having to eliminate some pay for people who've made more than $100,000 a year on an annualized basis. And we'll talk about that cap, I think, in a later slide. But keep in mind, all this pay schedule information is information that feeds into that PPP Schedule A, and that's where these calculations are performed. So Suzanne, next slide. So the alternate payroll period, using the exact same pay schedule, we take a look at the alternate pay period. And here we've got the first pay period after May 15th begins on 5/21/20. And so looking at our pay periods and our pay schedule, once again, we're allowed to include that entire payroll that was paid on 5/22 because it was paid after our 5/21 alternate start date. So we include that entire payroll. We include the payroll in 6/5, 6/19, 7/03, and now for the payroll that ends 7/15, because our alternate payroll ends on 7/15 as well, we're allowed to include that entire amount. So instead of having to take a prorate or reduction, we get the entire 36,923.04. And so the total in the alternate payroll period is 186,922.89. And, you know, we want to stress here that everybody's calculation is going to be different. Everybody is going to need to look at both your standard and alternate payroll periods, depending on how you paid, depending on whether you had furloughed employees that you were hiring back, depending on the number of people you have making more than $100,000 a year. Everybody's pay period is going to, is potentially going to have a different selection here. This is just an example to kind of give you some idea of the mechanics as to how this works. So I think with that, Suzanne, this is slide 9. And so Glenn or Suzanne, any other comments? Otherwise, we'll hand it over to Glenn.
No, thanks, Andrew. So just to reiterate what payroll costs are, you know, what's included, what's not included. We still have this question a lot. You know, gross wages, bonuses, commissions, hazard pay, tips in restaurant workers, you know, anything that was considered a W-2 wage last year. You know, the stipends for cars and housing. So what that means is if you're getting allowances, that is includable in their pay. If they're reimbursements for an expense, then that's not included. It would have to be included on their W-2. The group healthcare premiums, we feel like this is, so we still have questions on this in that we get, you know, for example, HSA contributions. We specifically, and the guidance specifically says the group healthcare premiums paid on a group plan. So things like HSA payments, we do not feel would be included in the payroll cost calculation. Retirement contributions, once again, this would be employer paid retirement contributions. Certainly anything that you accrue during the 8-week period. So for example, your 401k matching contributions, something like that. What we're not sure of is if, you know, you have until the due date of your return to pay last year's maybe profit sharing plan. So if you pay that during this 8-week period, can you include that? Well, we don't know whether you can include that or not. It meets the definition from it's a retirement contribution and it was paid during the period, but was that the intent of what they were looking for? Because those numbers can be very large. So we're still waiting on guidance for that in what we can include from a retirement perspective. And then finally, the state and local unemployment taxes. So it doesn't really, the language doesn't clarify state and local, but first of all, it has to be employer paid. So if you're in, I think we have about 13 or 14 different states represented today. If you're in a state that has, you know, state income taxes, then those are being paid by your employees, remember. And so their wages are gross wages. You would not include anything like that. But unemployment insurance, that certainly would be included. So the support that you're going to need, the application is pretty clear on what, you know, things that you need to be including. Payroll reports. Certainly, you know, if you've got payroll that include all the pay periods, including those ones that are after the covered period. So if you're paying it after the covered period, you want to make sure that you're getting that partial pay period in there if you choose that alternate method. And then certainly the tracking of your hiring policies. I just had a conversation with a client about this specific thing. You want to make sure that to rehire, you have written offers to rehire, especially if they turn you down. You want to document if a employee turns down employment, because this comes into play later on in the calculations when we talk about FTEs, okay, and that full-time equivalence. And so we just want to make sure we have the documentation that's supporting whether we tried to hire someone back and they refuse to come back to work. And then certainly hiring and termination dates for everyone that you have. If you furloughed people, make sure you've documented those. If you have people that retire and say, they don't want to come back because they're retiring, we need those examples as well, because that comes into the calculation differently too. So those are the types of things that are included in payroll costs. We can go, Suzanne, to the next slide. Now, what is not included? Okay, I've talked about this a little bit. Reimbursable expenses, I mentioned that as well, but the very thing that everyone keeps asking about is independent contractors. Payments to independent contractors are not included in payroll costs. I had a question yesterday. They had a marketing director in-house. And so that person actually ended up retiring during this. And so what they did was they hired an outside firm to do their marketing. Well, that expense to the marketing firm is not a replacement for the employee they had as a marketing director. So there's no replacement. It's a one-for-one. If you have an employee that doesn't come back to work, you need to replace them with another employee in order to get the forgiveness. You can go through. You cannot go through temporary labor like through agencies and things like that. They're not employees as well. Health savings plan contributions, I talked about that briefly. Life disability insurance, those are not included in payroll costs. And then most importantly, the wages over $100,000 on an annualized basis. Now, I believe the last time we spoke about this, we talked about what that really meant, whether it was on a weekly basis or on a biweekly basis or on your pay period basis. Well, all of that was answered in this latest documentation, and basically it's over the 8-week period. So it can't be more than this $15,385 for a person over a 8-week period. So can you pay your bonuses? You can pay, all sorts of different things, tips out, whatever you want to include in compensation. It just can't get over this $15,385 for the 8-week period. So, originally we were thinking that it was on, like, for example, a 2-week period, which was like $3,800 a 2-week period. If you like in Andrew's example where you had 5 pay periods, well, if you've got someone that you're paying $100,000 and you include that 5 times, you're going to get over that $15,385. So some of those, you have to watch those calculations to make sure. Now, S Corp owners are restricted to the lesser of this 8/52 of your 2019 compensation, or the $15,385. So if you took, S Corp, if you were an S Corp owner and you took wages of $40,000 last year, then you are limited to that 8/52 times $40,000. That's all you can pay yourself. So that, I believe, is what is not included in payroll costs. So I will turn it back over to you, Suzanne.
Thanks, Glenn.
Sure.
So the next part of the forgiveness, you've got 75% as of today that goes towards payroll, and you've got 25% that goes towards other costs. And so within those other costs, that other 25% is business mortgage interest. So one of the biggest questions we've gotten so far is, what does that include? Is it just real property, or does it include trucks and cars and copiers? And per the IFR, it does state that it is on real and personal property. So we do believe that the interest that you're making on other loans outside of real property are included in this cost. The key here is that the obligation must exist as of February 15th. So if you bought a truck or if you bought real property in March, that would be excluded from this. The interest and the obligation has to have existed at 2/15. Another question we're getting a lot is, can I prepay something or back pay something? That is not allowed. You cannot prepay the next 7 months of your mortgage and or truck loan. So what do you need to support this? What are they going to ask for? Because it had to exist at February 15th, it's very important over here on the right side of your slide here to understand that you are going to need account statements that include February, because you have got to prove to the lender and to the SBA that that obligation existed in February. So you will need to provide your loan amortization schedule. That is if payment slips are not available, but an AMO schedule would be optimal so that it shows the entire amortization of the loan from start to finish. And the second point here is canceled checks or lender account statements. Now, again, be very careful. Those lender account statements, you need to have them starting in February. So you've got to be able to prove that this obligation existed. So you'll need to have account statements from February through the end of your covered period. So in our do right example, they're going to need to have statements all the way through July. So I have an example of our do right company. If you remember, they have one mortgage and they pay $750 a month in interest. Remember that principal is not allowed to be included. So you cannot include that $250. So if you go over here to our little calculation, they paid their mortgage on June 1st and the interest piece was $750. They paid it again on July 1st and they paid it again on August 1st. So you get the full $750 for the June and July, but then in August, you need to prorate the piece. Even though you paid it in August, it was part of it was for July. So you get that 9 days here. So you can see the $750 taken over 31 days, and then 9 days is part of our covered period. So our covered period for do right goes until July 9th. So we get to take those 9 days. So the total forgiveness amount for mortgage interest for do right will be $1,717.
So Suzanne, just one thing to point out real quick for our audience is that, and you said you noted correct, as you noted, these non-payroll costs can be up to 25%, but that is a limit on non-payroll piece. That same limit doesn't apply on the payroll. Payroll has to be at least 75%, but can be up to as much as 100%. So
correct. Yes.
The limit is on the non-payroll side. Payroll can be as much as 100% of the loan.
And we'll talk about that a little bit later as well. The bill that's in the House right now is suggesting a 60-40 split, and Senate is, Senate wants 60-40, and the House wants to get rid of it. So we'll keep you posted on those types of things. But right now it is 75-25. So our presentation is using the 75-25. So one of the next other costs that is included in the forgiveness is business rent or lease payments. So this is line 3 of your application. And this is another big question we got. Does this include, facilities rent, fleet vehicles, copiers, trucks, forklifts, what can I include in my lease payments? Again, it was very specific in saying real or personal property. Again, key here is it needed to be under a lease agreement in existence at February 15th. That is probably the most important piece on these other costs is you can't daily rent, say a forklift or a roller or something like that. You can't rent it for the day and expect to be forgiven for it. So it needs to be under an existing agreement as of 2/15. So again, the support needed, very similar to that of interest, is you're going to need to supply a copy of the rental agreement. The rental agreement must include the dates of the service period. So if you started this agreement back in December, you should have a rental agreement signed in December of 2019 that would show that this was in existence at February 15th. The other thing, very consistent with the last, is canceled checks or the lessor account statements that you receive every month. And again, be very careful. You want to include February. So I know not all of my clients have, you know, they don't keep account statements. So these are things that you need to get on top of now. So start getting in touch with your lessors. I know equipment finance companies are very difficult to get a hold of right now. So get on the ball with this. Start getting account statements put together from February all the way through. If your, period ends in July or August, you want to make sure to have all of those periods ready.
Yeah, we know a lot of our clients don't get paper statements anymore. So if you get it via email, make sure that whoever's receiving those emails is saving a PDF copy. Start creating a file on your drive or your computer. And if you don't routinely look at those statements, a lot of people just have automatic pay and they never even open those emails. Make sure you know where those emails are going to. Make sure you know how to get them. If you've forgotten your login or can't remember how to access them anymore, now's the time to be figuring all that stuff out.
Yeah, the other thing I'd like to point out is, with the rent here in Florida, we see a lot of owner occupied, where the owner of a business owns the building in a separate entity and rents it back to his business. That's okay, and that rent is fine, but you got to make sure there is a rental agreement in place. So a lot of times we don't see those lease agreements in place or proper. So if, for example, if the lease agreement is rather old and they've changed the amount that they're paying and things like that, it's got to match the rental agreement. So you've got to have those documentations to be able to support your rent payments.
If you're one of my clients, I've beaten you up about that before, so you probably have those ready.
Come on, you beat our clients up a lot.
Especially about rental agreements. So you guys that'll be like piece of cake for y'all. All right, so if our do right example, now this is a tricky one. So if you're doing these questions and trying to figure out the answers, you be careful on this one. This is a sneaky one. So they've got 2 trucks. One of those trucks lease agreement started on January 1st, and one of those trucks lease agreement started on March 1st. So if you go down here to what can be included, the reason that truck 2 cannot be included is because their lease agreement did not exist at February 15th. They signed it on March 1st, and as such, they do not get to take that $500 for truck 2. So only one truck can be included down here at the bottom. So as you can see, they paid the truck payments on the 15th of the month. They've got May, June, and July. And as you can see, we did the same for this as we did for the others. We've prorated it. So Do Right will get 9 days of use in July for truck 1 only. So again, the key here was truck 2 did not sign until March. So they do not get to take anything on truck 2. All right, Glenn, I think I'm going to pass over to you the utility costs.
All right, great. So utility payments, what's included, what's not included, what support do we need? The inclusion is very straightforward for most of it. Electricity, gas, water. I'm going to skip over one, telephone and internet access. Those are the easy ones. The transportation, that's the one that's kind of not defined very clear yet. The thing that we get into is some banks are even saying that your gas in your car is the transportation cost. Well, the definition of the transportation or of the utility cost is that it must be an ongoing service agreement with a related contract. So, obviously you don't have that if you're putting gas in your car. So the transportation costs we're not sure of in what that really means yet, but most likely it could be, the transportation of goods or things like that you have a service agreement for. Everything else, telephone, yes, includes cell phones, internet access. What it does not include though, and we'll get into this on the next slide, the example of the next slide, but what it does not include is, we don't think, is reimbursements for these things. So is reimbursing someone for a telephone that is not in the company's name an item to include? We don't think it is, But once again, there's some guidance there that lacks. So we do think it has to be a business utility payment and not a reimbursement. So some of the support that you're going to need, certainly copy of invoices from February, because that's our beginning date. It's got to be in service as of February 15th. And then everything that's covered through the covered period. Certainly canceled checks, account statements, those things as well are going to be needed in order to prove these utility payments and what they are. So let's go on to the next slide and talk about our Dudley Do-Right example.
Sure, just to add one thing to that,
yeah.
back to your topic of discussion of the gas in your car, for example, you're not going to have a copy of an account statement or an invoice showing that you have a standing Speedway bill, that's $50 a week for the, months of February and March. So that goes back to our position that those types of transportation costs will not be included because they do not have an ongoing service agreement that was in place as of February. So especially when it comes to providing support, you won't have any account statements that would cover items like gas in your car.
And Suzanne, just a little more color on that too. This isn't something that probably a lot of our clients, a lot of people on this webinar may not experience this, but there are certainly jurisdictions out west in the Northeast that actually get billed for a transportation utility charge, and it's billed by a municipal government or a local taxing authority or taxing unit. And so, keep in mind that there's that in existence out there. And so some of our clients, that would be very clearly a transportation utility cost that's billed in accordance with the service agreement. And also, let's point out too, a lot of this confusion is coming from the independent final rule for independent contractors, which specifically provides some examples as a permissible use of funds on things like fuel in cars and that sort of thing. And it's important to keep in mind that if you're reading that rule and wondering what says that gas applies, that is first of all a rule for independent contractors, and B, that part of the section applies to the definition of permissible uses. When that same rule shifts over to what is actually forgivable, it defaults back to this has to be in accordance with the service agreement that was dated before February 15th. So I imagine we're going to get some more guidance on this at some point, but just keep in mind if you find this issue confusing, you're not the only person out there.
Great, thank you guys. So let's go on to the example. Once again, our covered period is May 15th through July 9th, and our utilities average $500 a month, and they're all paid on the 21st. Wouldn't we love that? Have all our utilities paid on the same day? So what do we get to forgive here? What do we get to include in this? And it's very similar to the example that Suzanne just gave. So our cover period starts the 15th. So on the front end, once again, we get a cash basis. So when we pay on the 21st, that's included. Our middle month there, June 21st, that's included. But then when we come to our final month, that's when we switch to accrual basis. And so we get through the July 9th period. So we get 9 of the 31 days in July. And so we would get $145. So for the 1145.16, so we get that combination once again of cash versus accrual. And then also pointing out that this is our covered period, not the alternate covered period that we may include for payroll. Next slide.
Thanks.
I'm turning back over to you, Suzanne.
Pass on the beef right now to Andrew. One of the more complex pieces of the application, as I'm sure you guys are aware if you've already taken a look at it, is obviously the calculation on the Schedule A of the salary and hourly wage reductions and FTE counts and so forth. So Andrew has agreed to tackle that for us, and that starts on line 5.
All right, thanks, Suzanne. So much to, I'm sure, everybody's disappointment, we're not going to try to delve in and get into the actual manual calculation process for Schedule A, and I'm going to go into why in just a second. But part of that is because of just the large number of variances here. But we want to try to hit the highlights, are things that you need to be aware of, especially as you're planning for forgiveness and making decisions over the next couple of weeks. We know that many of you are 4 to 6 weeks into your covered period, and so it's getting kind of down to crunch time on making decisions about some things, and we want to try to point out some of these highlights here. So once again, line 1, the general payroll cost, and then the next couple of slides, all your payroll information is all calculated on the Schedule A. There are 2 reductions to your forgiveness amount that depend on salary and hourly wage reductions, and then one on full-time equivalency. We're going to talk about both of those real quick. So the first one, line 5, is a reduction based on salary or hourly wage reductions. So the key points here to keep in mind, first of all, each of these 2 calculations, the salary and hourly wage reduction and the FTE calculations, they have to be done for each employee. If you've got 10 employees or even 20 employees like our do right here, that may not seem so overwhelming. But if you've got 100 or 150 employees and a bunch of part-time individuals, you're a restaurant or a retailer, you're going to need some kind of tool to do this. This is not something you're going to be able to do manually. So it has to be calculated for each employee. There's no impact, there's no reduction if your salary or wage reductions are less than 25% based on an average from 1/1/20 through 3/31/20. So as long as your reductions, if you made any at all, were less than 25%, you don't have to worry about this. If they were greater than 25% and the salary or comp is restored by June 30th, then you fall into what's called the safe harbor provision. So once again, trying to help our clients, arm our clients with information to make decisions now. If you're in that, got a couple more weeks left in your covered period, you need to be looking at this and doing a little bit of scenario analysis to understand, do I need to, if I reduced anybody's comp, do I need to bump that up so that by the pay period that is covered at 6/30/20, you meet your safe harbor provision requirements. If you don't meet if you had a reduction that exceeds 25% and you can't meet the safe harbor requirements, then your payroll, the amount of payroll that you're forgiven for is going to be reduced by the reductions in excess of 25%. So the first 25% is kind of a gimme. But if you say reduced overall comp by 30% across the board, you're going to have a 5% reduction. So once again, highlights calculated separately for each employee. At 25%, you kind of get the first 25%. There is a safe harbor provision, and the calculations based on reductions in excess of 25. All right, Suzanne, next slide. So line 7, you'll notice we skipped line 6. Line 6 is just add the previous 2 lines. So we're not going to go over basic addition again for our web viewers. Line 7 is the FTE reduction quotient. So this is important because this is not a dollar for dollar reduction. This is a percentage reduction in the entire amount that you're able to apply for forgiveness for. And so the FTE reduction quotient takes your average FTEs for either your covered period or your alternative payroll period, whichever one you selected, and you divide it by the average FTEs for a chosen reference period. And those reference periods, if you're a non-seasonal traditional employer, you've got 2 available reference periods. One is 2/15/19 through 6/30/19, or you can choose 1/1/20 through 2/29/20. If you're a seasonal employer, you have access to a third period, which is actually any 12-week period falling between 5/1/19 and 9/15/19. So there are actually a number of 12-week periods that fall in that range. And so if you're following this and kind of doing the math, you're realizing that, at a minimum, you've got 4 sets of calculations to perform. You've got to run your covered period with each of your 2 benchmarks, and then your alternate payroll period with each of your 2 benchmark or reference periods. So, and then if you're a seasonal employer, and have one of those 12-week periods, then you have to run the same 2 calculations for every single one of your 12-week optional seasonal benchmark periods. So there's a lot of a lot of alternate calculations that have to go on here in order to make sure that you're maximizing your forgiveness application. The quotient applies to the entire forgiveness amount. And so, I mean, this, just to back up, the calculation is very simple. If your average FTEs were 1 in your reference period and now they're 0.7, then your quotient is 70%. And so that means your entire forgiveness amount is going to have a reduction by 70%. It's going to be reduced by 30% to 70% of the total. There is a safe harbor. So if FTEs were reduced between January 15th and April 26th, but then restored once again by June 30th to those 215 levels, then you'll fall in the safe harbor and the FTE reduction quotient won't apply. And there are exemptions. You get to exempt employees from the FTE calculations who rejected offers to be rehired, who were terminated for cause, or who made a voluntary reduction in work or left, retired, so on and so forth. So there are some exemptions to the calculation. So Suzanne, the next slide. So obviously a big piece of these, and a place where we've gotten a lot of questions, is in the process of calculating FTEs. And early on, that was very confusing because there are all sorts of rules out there for calculating FTEs. There were existing SBA rules. There's just lots of different ways to look at this. Well, we got some clarity with the forgiveness application. So once again, full FTEs have to be calculated per employee, and the borrowers may choose either the standard or a simplified method. And so the standard method takes the average hours paid per week and divides it by 40, and then rounds to the nearest tenth. So once again, 40 is the magic number here. That's what, for forgiveness purposes, and this has been very clear in the guidance and the loan application, the Treasury has come out, the SBA has come out and said, we think 40 hours is a full-time work week for most Americans. And so under your standard method, it's the number of hours worked divided by 40. So if you worked 40 hours, that's 1. Obviously, if you have an employee working 20 hours, then that's 0.5. If you have an employee working 10 hours a week, on average, that's 0.25. And you round to the nearest tenth. The simplified method is employees working 40 hours or more get 1. Employers working less than 40 hours get 0.5. It's very straightforward. But once again, you're looking at a situation now where you've got to run this calculation under both the standard and simplified method to determine which one is best for you. So we just added another variable. No employee may have more than 1 FTE. So everybody maxes out at 1. So even if you have an employee who normally works 50 hours a week, you don't get 1.25 or 1.3 for them rounded up to the nearest tenth. You get 1. So
and you cannot make your employees work 80 hours for the next 8 weeks
to get extra FTEs. That's right. No, yes, that doesn't help, unfortunately. So or fortunately, depending on who you're looking at. The
goal, Andrew, and the goal here is to get the lowest FTE calculation that you can, obviously, to limit your exposure on having a reduction.
Yeah, that's right. I mean, that's right. Overall, you want to make sure that you're getting a number where your covered period or alternate payroll period FTEs meet or exceed your benchmark or reference period FTEs. And so this is just a couple of examples of the calculation. So you can see here we've got 4 example employees. One works 45 hours a week, one works 35, one works 25, one works 12. The employee working more than 45 hours a week under both the standard and simplified calculations, they get 1 FTE. Employee B, who works 35 hours a week, gets 0.9 FTEs under the standard calculation, but only half an FTE under the simplified calculation. Employee C, who works 25 hours a week, gets 0.6 and 0.5 under the simplified. Employee D gets 0.3 under the standard and 0.5 under the simplified. So you've got 2.9 FTEs under the standard calculation and 2.5 under the simplified calculation. Obviously, the simplified calculation could have some benefits if you're bringing people back who, who are working just a small amount or smaller than normal, and you're able to get a full half of an FTE. So once again, these calculations are very position or situation specific. All right, Suzanne, the next one. I won't go through this slide, but it's the same thing. It just shows you kind of another mechanism here where we've got nobody's working more than 40 hours a week, and so obviously the simplified calculation takes an even bigger hit in this example because that you don't have anybody that gets a full FTE in this. Well, under the standard calculation, the employee working 38 hours a week does get a full FTE because it rounds up to the nearest tenth, but under the simplified calculation, nobody gets a full FTE. Okay, Suzanne, on the next one. And so real quick, just to summarize, we walked through this very simplified company example, and once again, don't put too much, we don't want anybody to put too much weight on any of these numbers. This is just to give folks an example because we think this is something that many of our clients are going to see. And this scenario, and assuming there were no FTE or wage reduction issues, Do Right was able to document $190,930 in forgivable expenses. Remember, their loan amount was $250,000, so that gives them $59,000 approximately that's going to have to be repaid. We think this is going to be a fairly common circumstance for many of our clients to have some portion of their PPP loan that's going to have to be repaid. The key factors on why Do Right had to have some repayment here in this example is they had pre-loan staffing cuts, and it took them a while to ramp their staffing back up, and they had low non-payroll expenses. So they weren't able to maximize that 25% of non-payroll expenses. So now is the time to be discussing these issues because you do have some flexibility. If you've got employees making less than $100,000 a year and you want to try to give them some hazard pay bonuses or something like that, you need to be thinking about making those decisions now. And just keep in mind, each case is unique.
Yeah, and certainly, if you just kind of look at the numbers here, and on the next slide, we're going to talk about the same thing. Is that if you look at the payroll, it's 186,000. Well, we were averaging in 2019 that $100,000 number. So of your $250,000 loan, $200,000 of it was quote unquote payroll that you could pay back, and then the other 50 was these non-payroll costs. And you can see the disparity of where he's off in trying to make up for those things. So you certainly can't make up for items that are in the non-business, because typically those are what they are. I mean, you can't change your rent, you can't change your utilities, and so those are what they are. So you have to take advantage of potentially maybe even paying your employees a little bit more, so that you don't have to give it back, and that you put more money into your people's pockets. So that's really important to understand, where you are, especially coming towards the end.
Yeah, I think it comes down to final week decision. If you're running the numbers and you see where you're at and see where you need to be, you can make decisions, better than, I would say, to wait more towards the tail end of your term. Obviously, stay up on it, keep tracking, keep a good pulse on it. But, some of these types of decisions will come down to the last week or so. So go ahead.
I was just going to say, Suzanne, something else that we've told lots and lots of clients over the last few weeks is that ultimately you want to make sure you maximize the forgiveness you're entitled for. But the goal is not necessarily to maximize forgiveness. The goal is to make sure you properly account and capture everything that you're entitled to capture. In this example, it is what it is to a certain degree. And if you've gotten the benefit of the loan to cover your appropriate payroll, you've covered all your allowable non-utility expenses, then and you end up having to repay some of the loan, that you've used the funds appropriately. The most important thing I think for clients to understand and people to be aware of is that, if your business is struggling in other areas, you know, if you're going to have to repay some of this loan, don't find yourself getting into a cash crunch because you've used funds that you're going to have to repay in a non-forgivable, you know, for a non-forgivable cost, and then find yourself unable to repay the balance.
And that's where it comes into play of keeping this money in a separate bank account, so that if you do come up short, I mean, in this case, he's $60,000 short. You know, if you had commingled those funds with your, you know, in your checking account and then started paying other things, and then all of a sudden it comes back to repayment time, you're like, okay, where's that money going to come from? And so it's really important that if you are, you know, if your cash flow is not great, is to keep this money in a separate account so that you don't spend it on other things that aren't allowable.
No, absolutely.
And just to add to that, you know, right now, as of today, you would have until the end of the year to start making payments. Those are deferred till the end of the year. So if you do have to repay some, just remember that the start date of those payments is not till the end of 2020. So another area where we've been getting a lot of questions is regarding, you know, Schedule C and independent contractors. So Glenn's going to touch on that real quick for us.
Yeah, sure. You know, really not much has changed since our last webinar about independent contractors. The basic framework is the same if you have employees. All the calculations are the same. Everything is the same if you have employees. For owners, the payroll cost is basically 850 seconds of line 31 on your 2019 1040. You know, this kind of is in line with those S Corp W-2 wages that I was saying, is like whatever you made last year on your S Corp wages, then that's what, you know, same thing for independent contractors. So it does not include, though, owner's health insurance or retirement benefits. So it is strictly 850 seconds of line 31 of your 2019 Schedule C. So if you haven't completed that, if you were one of the few independent contractors, Schedule C people who got a loan before they came out with the rule of you got to do your 2019 Schedule C, you may want to get that done really quickly to make sure that, you know, you're not spending money that's not yours. Because we feel that, you know, just like we were saying, you know, Dudley Do-Right didn't use all his loan, is that the independent contractors are not going to be able to use all of their loan, especially if you have no employees. I mean, you're looking at no rent, no interest, no utilities, you know, things like that. You may not be able to pay everything back, and so or to utilize everything, and so you're going to have to pay it back. So that's really the key to understand. Is if you're an independent contractor, you need to watch this very carefully. Let's go to the next slide, Suzanne, and I think we are.
Yeah, we're getting into our frequently asked questions. So we've put together a couple that we've just been getting a lot of. I know Jamie has, as of last check here, 31 or so from today's presentation. So that means we're doing a good job because we only have 31 questions. So
It's at 44.
Oh, 44. Okay. Well, still not bad considering the last webinar we were on, there was 1,372. So not too bad, but we've got a couple listed out here that we had either someone posted when they registered or just a commonly asked question that we're getting. So we're going to walk through a couple of those, and then Jamie's going to read us a few that have come in. We've still got plenty of time to answer your questions, so please, you know, get those over to her so we can hit them. And as she mentioned earlier, if we don't hit them on this webinar today, we will follow up with you and answer your specific questions. So Glenn's going to go over some of the provisions of the new House bill, which we understand is under vote today. Actually,
it was passed this morning.
Okay.
So they have already voted on it. Right. And remember, so what does that change? It changes absolutely nothing, because the Senate still has to approve it, and then obviously, you know, that the president has to sign it as well. If you're in our demographic and age group, you'll have to, what was it, the Schoolhouse Rock guy that you know, it has to go through all that stuff. That song is drilled into your head. Well, this, you never thought it would come back to you, but now it is. So really, you know, the House bill extends the maturity of the loans to 5 years. So right now they're 2 years, so they can go, I think the law was written up to 10. And then so they're getting an extended maturity of at least 5 years. Extended forgiveness, this is huge, from 8 to 24 weeks. So what does that mean? That means that pretty much everything that we just did would be obsolete. That's why Suzanne referred to as May as the longest month ever. For us, it has been. It's like a day is like dog years. It is to, for humans. I mean, it's exponential. So, the 24 weeks now, all of a sudden, you've got so much more payroll, so much more. I mean, it's basically a way for people to make sure they spend all of their money. Because like we have proved is that this 8-week period, it's going to be hard to spend all that money. Move the cover date from June 30th to 12/31. That's for the employees and payroll and things like that. I mean, here we are, almost into June, and most of my clients are not at full force yet. So especially in the retail industries, they are, they can only serve so many customers at a time. And so really, is that 6/30 date realistic to have a full payroll in a down economy, like you had in a booming economy back in, last year in 2019. So then the split of between payroll and other expenses going down from 75/25 to 60/40. In all honesty, I don't think this is a big problem for a lot of clients. Certainly, if you have, have large fleets and things like that, that you may have large lease payments and whatnot. If that's your industry, this could affect you. But for the most part, like service industries, retail, restaurants, manufacturing, most of this is going to be, in that 75/25 split. And then filing, allowing the tax deduction for payroll expenses. Seems kind of silly that they didn't include this to begin with. Your employer side of your payroll taxes have to be paid with payroll. Well, if you have no revenue, where are you going to get those payroll expenses that you're going to have to pay for? And so I think this was the kind of the thought of, hey, let's throw the employer portion of the payroll expenses in there. And then also from this aspect, it also means that they talked about the deduction itself. So for the income, when we have a loan forgiven, that is non-taxable income. Well, a rule in the tax bill says, well, if you have non-taxable income, you can't deduct the taxes that you have deduct from taxes the expenses related to that non-includable income. And so right now, all these payroll expenses, the utilities and all that, everything that's forgiven, you're not going to be able to deduct. We don't think that was the intention. And so now the House is coming back with, okay, are we going to be able to make these deductions allowable from, even though they were forgiven and not includable in income? So, okay, so next slide.
Sure. Our next question, which we're getting a lot of, is will I be audited? So Glenn's going to talk about that.
Yeah, so I get that as a tax professional. I get that a lot anyway.
And I'm an auditor, so I get it all the time.
Yeah, you audit, but that's not the audit they're talking about.
I understand.
Your audit's a good audit. My audit necessarily isn't a good thing. But look, if your loan exceeds $2 million, the SBA is going to review your loan. That's automatic. It's going to happen. But they retain the discretion to review all others. So certainly at the very beginning of this, we heard and saw fraudulent claims for getting PPP loans. Well, I am sure in the back end there's going to be some fraudulent expenditures for getting to the forgiveness. Unfortunately, that's the kind of world that we live in. The review is intended to determine whether the loan proceeds were properly calculated and allowable expenses. That's really the key. If you do your due diligence, if you get assistance, if you're unsure and get assistance for what you have, and if you have your documentation, original documentation, then you're going to be fine. And so if, I don't think that worrying about an audit should be an issue if you've got all your documentation in place. And that's certainly something that we're helping our clients with, and we can help you with as well. So Suzanne, I'll turn it back over to you.
Thanks. And just to add to that, the SBA is the one that's actually doing the audit. But keep in mind that your lender is the one making the determination initially on forgiveness. So that is another one of our frequently asked questions here is, what does this whole process look like? Where and when does the SBA get involved? If I do get audited, at what point would I find out? And so the step-by-step really breaks down as follows. So you complete your application. You submit it to your lender. So your lender, and in some cases, you need to check with them earlier than later because some lenders are setting up portals. And so they've got a portal that follows all of the documentation requirements from the application and the instructions from the SBA. And so you actually just drag and drop your documents right onto their portal. So check with them early to see what type of platform they have. If you need to be printing all these things out and sending them a snail mail package, probably not the case, but you need to know these things in advance. So check with your banker to see how that application will be made, whether it will be online, all of your scanned documents will be uploaded, if they have a portal, et cetera, et cetera. So check with them now early. They will have 60 days to look at your application and your supporting documentation, and your lender is the one right now that is determining the forgiveness amount. So like I said, if they have a portal, they'll have someone on the other end that's looking at your application, looking at your supporting documentation, and then making a call on whether they think that you should be forgiven for what you have submitted. So there's quite a few things today that we've talked about. And one of our FAQs coming up is, if you let people go and then you rehire them, what do you need to submit? So a lot of this is going to come down to a lender decision. So you've got to be able to prove your case. You've got to be able to prove your point to, a logical person like your lender. So keep that in mind. We've talked about it a lot in the first and the second webinar. The intent of this program is to get money back into, employees' pockets, keep your business running, try to keep businesses from going under. The intent of this program is not, to help people overspend and spend money on things that are frivolous. It's to keep businesses in business and keep employees employed so that there's more money funneled into the economy. So your lender is going to look at it from that lens. So keep that in mind when you're submitting things, is what would I do if I was a lender? Would I approve this? That's always, again, a good rule of thumb when you're thinking about things and whether they would count. Next, lender has 60 days to review, and then they notify the SBA. So they will notify the SBA, yes, we have approved. So in our case, it was 190,000 or so. Do right will be approved for 190,000. The SBA then has 90 days to review that submission from the lender with their approval amount and then pay the lender. And so as we've talked about timelines here a couple times, it's still questionable whether this will extend out further to 24 weeks or stay at 8. But just keep in mind when you're thinking about when you may have to repay this loan, the SBA has 90 and the lender has 60. So that's 5 months right there. So keep that in mind that you may not get a final determination for 5 months after you submit your application. So that is close to the year end, depending on your timeline here. So at this point, payments have to start at the beginning of 2020 or 2021, end of 2020. So keep that timeline in mind. You will want to probably file as early as you can. We actually don't think that's going to be a problem. Most of our clients are itching to file because they've got their ducks in a row and they're ready to go. But if you do not, just keep that in mind that you want to file earlier versus later. Then after the SBA has 90 days, they will then notify your lender and they will say, okay, it's approved, and then they'll pay your lender back. So like I said, you probably will not see that forgiveness until your lender is given the money back from SBA.
Suzanne, just real quick, and as you note, this period could easily extend beyond the end of the year, the 60-day and 90-day, depending on when you actually apply. In the interim final rule, there's actually a provision that states if you have already started to make payments or reductions on the loan, whether you start paying early or whether you start paying at the end of the year and make ordinary reductions, if you pay down the principal and you pay down principal that ultimately is forgiven, then the lender has to turn around and refund you any principal that you paid plus interest. So just something to keep in mind.
Yeah, thanks for adding that. I was not aware of that. Our next question is one we've kind of touched on a few times in this, and Andrew's going to take it. And it's the question about what if I laid off or reduced hours for employees? We've had a lot of clients in this case. You know, initially when the downturn of the economy started, you know, people made good business decisions and they, you know, cut hours, and potentially some non-performers were let go, and they're thinking about cash flow. And so then in the attempt to reduce costs, this came through, and then they reoffered, you know, these employees their job back. And so some of them said, you know, I really don't want to. I think I'm going to take FMLA, or you know, I have to stay home with a child that's no longer in school. And so they declined that offer. And so what happens there? Does your company get penalized because they don't want to come back to work?
Right. And so, you know, once again, this is something we have touched on this already, and I don't want to just read these rules to you, but, you know, just keep in mind that this is one of the exceptions to the FTE quotient calculation. So, you know, there are some, you know, this is outside the safe harbor. These are actually people you get to carve out of the FTE calculation. But if you're going to do this, you have to, you know, the key word is document, document, document. You know, if you got to make a written offer to rehire, you've got to prove that you made that offer to rehire and restore the reduced hours. You've got to, the offer has to be for similar comp and wages and similar hours. You have to document that the offer was actually rejected by the employee. You got to keep all those records together, and you've got to show that you notified the applicable state unemployment insurance office of the rejected offer of reemployment within 30 days. So, you know, these are some things that can easily get lost in the ordinary course of running your business, especially if you have a large number of part-time employees, because you're in manufacturing or service or an industry, you know, where you have a lot of part-time people. Keeping and maintaining this documentation so that these people don't count against you in the FTE calculation is going to be critical.
Yeah, I mean, especially in the low wage environment of, you know, service industry type people, you know, for, you know, housekeeping, restaurants, servers, things like that, where, you know, the offer of reemployment is less than what they're making on unemployment. And that's the problem, is that, you know, that $600 kicker that is still in place is really coming into play with some people's decisions that, you know, live week to week. And so, you know, you really have to make sure you get that documentation so that it doesn't count against you if you go and then, you know, do something different with their, you know, position, or even if you can't rehire in time for that position. And so you just want to make sure that you don't get that reduction in your forgiveness because someone has refused to come back to work and you didn't document it properly.
So we've come to the end of our formal slide FAQs, and Jamie, it looks like you're up with some of the ones from today.
Yes, so we have received just about 60 questions. So I don't think we're going to have time to go through all of them, but I do have a few marked I want to make certain that we get to with the group here today. We have had several people ask, how soon after your 8 weeks is over do you need to complete and submit the application to your lender? You guys weigh in on that?
Sure. So there is right now not a timeline a definitive date that you have to submit it. Again, time is of the essence from the standpoint of your lender has 60 days to review it, and then SBA's got 90 days to review theirs. So at this point, unless y'all are aware, I am not aware of you've got, you know, 10 days or something to file your application. but it is suggested that you try to get it in sooner versus later based on the time that it may take to get it ultimately forgiven.
I would agree with that.
Yeah, me too.
So talking a little bit about employees here, if you have an employee who went out on medical FMLA for a baby during the covered time, will that count against us on the FTE counts? Do we know?
I don't believe so. I think, you know, if they're out on FMLA, that they are still employed.
Still employed.
You know, so you know, whether it's paid FMLA leave or unpaid, you know, depending on your company policies. And remember, with the PPP funds, I mean, certainly, you know, if you choose to pay them while they are at home, you know, for that, then that's fine as well. You know, just so, you know, it just kind of depends on the situation, but I don't believe it'll affect the FTE. Andrew, you have any comment?
No, I would have to, I just have to go back to the guidance and double check, but I think that would either like you said, Glenn, they're either technically going to still be considered employed, or they will, it would be considered a voluntary reduction, and that would fall under the exemption for voluntary reduction.
Right.
Yeah.
I agree.
All righty, thanks guys. We do have a few more here on eligibility for these utility expenses, so I want to get to these also. Let me try to find them really quick. Internet, phone, I know that was one, your cable.
Yes, all included. Again, it has to be in effect as of February 15th. So if you just got internet last month, that would not count. But if you have had internet set up since February 15th, then you can show your account statements from February 15th, your utility bill for internet would be forgiven.
We had someone also ask about trash pickup.
We're considering sewer and waste management a utility. There hasn't been formal confirmation, or vice versa. It hasn't been formally declined. So it is our opinion that trash and sewer is considered a utility.
For many, many people, that is billed with their water bill, and I think it would all, you know, it would all typically be included.
Right.
We had another Vanessa Gray here ask, if an employee earned a very large commission check in February prior to the covered period, will that count against the wage reduction calculation?
The wage reduction calculation, it shouldn't. You know, if it was received in February, you know, the loan was based on 2019 numbers, and then anything that you pay them during the covered period is what's limited to that $15,385. So if it happened in February, it shouldn't affect anything. It is not a cumulative up to $100,000. The $100,000 number in and of itself is irrelevant. It's the $15,385 that's paid during the covered period, or the alternate covered period for you know, for payroll if you choose that.
I think maybe the question too there, Glenn, is would that commission or increase perhaps in that person's pay, would they be deemed as having a decrease in their pay?
So, and the answer there is actually, so that is something you have to be considerate of, because to determine, remember we talked about the first 25%, you're looking at whether or not salaries or wages were reduced by more than 25%. Well, that comparison of the covered period or the alternate payroll period is to the period from January 1, 2020 and March 31st of 2020. So if you had somebody received a big bonus in February of 2020, that could potentially impact that calculation. Just pointing that out.
Yeah, and the other thing you have to remember though is that the $100,000 doesn't come, if for someone making over that $100,000, the reduction doesn't come into play. And so if someone's making over $100,000 and they get a big bonus in February, it's kind of irrelevant because it's over $100,000, and so only up to $100,000 is covered. So, you know, it really kind of depends on the person and the situation of whether it's going to affect it or not.
A couple more eligibility questions. Interest on a line of credit.
We're considering interest on a line of credit to be included in the forgiveness amount. So again, your line of credit can't be new as of last month. It has to have been in existence as of February 15th. You have to be able to show your statement showing your interest for those periods. But again, that's one area where there has not been confirmation that it is included, nor has there been confirmation that it is excluded. So right now I would say track it. Again, our understanding is that it would be, but again, that, you know, when they come out with further guidance, that piece may change.
Yeah, and I would just add there, you know, if it's a traditional line of credit that is secured by a lien, a mortgage where you have mortgaged real or personal property, if it's just purely unsecured, it may not qualify.
Right. That's a good point.
And the other thing would be that if, you know, you would not be able to increase, you know, or draw down on that line of credit, you know, after, you know, February 15th, and have that count, that interest count as well. So it would have to be only the principal amount, the interest on the principal amount as of February 15th.
Right.
All right, thanks guys. We have another question here from Shelley Hull. On the truck lease example, you are able to take 2 payments plus 9 days. Assume this is 9 weeks total. Can the same be done for payroll? Make a short payroll to allow more payroll expense than the 8 weeks using the basis of paid date?
You don't really have to,
Right.
because the payroll date, even if you pay it after, it covers up through the payroll period, you know, the covered period. So if you pay in the 9th week, you know, that your payroll, you're going to get 1 week of that anyway. I don't think you can pay in advance for, you know, a 9th week and count that, because I don't think you can do that with payroll.
Yeah, and Glenn, you're right. There really would be no advantage to trying to move the payroll date, because the way the language works, it's payroll actually paid or incurred through the end of either your covered period or your alternate payroll period, as long as the payroll that is incurred is actually paid on the next normal payroll date. So you don't get any advantage from moving. And that also applies to the utility examples. You have to, those utilities, if you incur a utility but pay it after the end of your covered period, you have to pay it on the next normal due date. You can't skip it and pay it, say, August. Or
yeah, I mean, once again, remember that this is kind of a hybrid accounting. So it's cash on the front end. So at the beginning, if you get your money on payday, then, you know, that payroll counts, even though the pay period you're paying for was prior to you getting the money. But then in the back end, if you're 1 day short, if you have to pay, you know, 1 day after your 8 week period, then you still get everything but that 1 day. And so, you know, it's accrual on the back end. So it's covered.
Right, as long as it's paid by on the next normal payday.
As long as it's paid, you know, in the normal payroll cycle.
And that was a big thing in our first webinar. We were saying, you know, hey, we don't know yet. You may want to change your payroll date to fit within that period. So the guidance did come out that in fact is not necessary. So you guys don't need to go, you know, moving mountains and getting payroll dates moved because of the way they wrote it. As Glenn just mentioned, you will, you know, on the back end be allowed to accrue, and as long as you pay it on your next payroll date, you're okay. So, you know, chill out on calling your payroll company and trying to get pay dates moved. You know, that's a big deal. So we're glad that they took that into consideration when they wrote the final right there.
Yeah, and I would, you know, speaking of payroll companies, you know, I would, you know, once again be weary of the reports, you know, that payroll companies are getting. Just make sure, you know, if you've got a CPA, if you need help with us, you know, from us, in reviewing those documents to make sure they are correct. I've seen different things from different payroll companies, different interpretations. And so just be careful for what they're producing, and make sure that you understand the report and actually everything that goes into it.
We have one question here that says, if you can fully support loan forgiveness amount by payroll costs alone, do you have to provide support for other expenses, or can you leave those lines in the forgiveness application blank?
You can just leave them blank. So if you've got your full amount in payroll, that's fine. You're allowed up to 100% for payroll. You just are maxed at 25% for other costs. So if that simplifies things for you, absolutely. Just stick with payroll, fill out the payroll piece, and have your payroll documentation ready. If for some reason then you have an issue with getting forgiven on just for whatever reason, then you would have that other documentation ready. So I would say still track it. But if you're at 100% for the payroll, I would just go ahead and fill it out with that.
Do you guys think, go ahead, Andrew.
I would just only add, I guess my opinion, you know, if you're already tracking it, I mean, Suzanne's advice is absolutely right. You should track it. If you've already tracked it, then actually calculating the numbers and filling in the application doesn't hurt. And, you know, my advice would be, certainly the belt and suspenders approach, which I'm always a fan of, would be to go ahead and plug the numbers in and submit it. And even if you know, if you apply for more forgiveness than your principal amount, then that's great. And if somebody makes a decision at some point down the road that they want to exclude some piece or another, then you've got a little bit of headroom to cover it. So anyway, just another.
Yeah, I would certainly not, you know, I think line 8 on the application is your modified total, so to speak. I would not be trying to equal that to the loan amount, because if you do get something, you know, disallowed in your expenses that you've turned in, and it's only equal to the PPP loan amount, then now all of a sudden you're in a position where you've got to pay some back, even though you spent it on other things. You didn't claim it here. So it's always better to claim more here and then have it limited by the loan amount than you know, just claim what the loan amount was.
All right.
Perfect. All right, I think we've got time for one more question here before we close out. This one is from Kim Weinstein. She asks, can we get more information on hazard pay bonuses our employees have incurred costs from working from home? Would this fall under that type of bonus?
So I'll just take a quick stab. If you're reimbursing employees for hard costs, those are likely not covered. But if you're just making a hazard pay, increasing their W-2 wage income, that is potentially a forgivable cost, subject, of course, to your caps, your $100,000 cap. Suzanne and Glenn?
Yeah, hazard pay was actually put into the new IFR as allowable as our bonuses. So anything that's being considered wages can be included in your forgiveness amount. Like Andrew said, if you're reimbursing for, you know, stay-at-home working costs, that would not be included unless you're just increasing their salary and telling them, hey, if you want to spend this money to upgrade your home office, then great. Then they have that option to do what they want with that money. So if it's salary or hazard pay or bonus or commission, whatever you want to call it internally, that would all be considered as forgivable.
Great point. You know, if you've got the choice between writing a check, you know, having your employee turn in an invoice for a new monitor or, you know, something like that, or just paying them an extra $250, pay them the extra, you know, my advice would be pay them as a hazard or bonus. Don't, because that monitor is not going to be a forgivable expense, while the W-2 income would be.
Yep, just keep in mind, you'll pay payroll taxes on that bonus or hazard pay, whereas a monitor wouldn't. But under the circumstances, you know, you'd have to run the math to see, you know, what would make more sense.
And unfortunately, we're not able to get to any more questions, but as we shared at the beginning of the webinar, we will save all of these and we'll follow up with each of you afterward. Make sure you get the answers that you're looking for. So let's go ahead.
We've got a few. Yeah, these are just, this is just a general slide on where you can see some of the updates. Everything that we've talked about today has been in an interim final rule and or the actual application. And so these are the two main places that our firm has been looking for, you know, guidance and new issues, new regulations being issued. So Jamie, I think I'll pass it over to you again.
Yeah, so thank you all again for joining us today. We understand that there's been a lot of information that's been shared since all of this started, what seems like a very long time ago, but we have been keeping record of all of the information that we've collected on this subject, COVID-19 just in general, which includes this PPP subject, which we focused on today. So if you haven't already checked out our COVID-19 Resource Center, go ahead and do that. You'll find lots of information there. Any webinars that we've held in the past, we're putting there as well, materials and things for you all to reference. We know that this is sort of uncommon ground for many of us, and so we want to make ourselves available to help answer any questions that you all have. And to that point, it segues me perfectly into this next slide, which is that we're here to help you all navigate the forgiveness process, and hopefully you realize that we want to meet you where you are in terms of the issues that you're facing or the needs that you have. So if it's just a matter of being available to answer questions or provide some more confidence in these decisions you're making, please keep us in mind. We're also able to help you prepare your application and review that with you before you submit it, if that would give you some more peace of mind. So please don't hesitate to reach out to anyone on our team. We've got our folks here speaking today, their contact information included on the slide. You're also more than welcome to email ppp@saltmarshcpa.com. That is sort of our repository where we're asking our team to take these requests and questions that we're receiving and make certain that we're getting back to you all. So we're here with you in this, and we want to help you in any way that we can. So please don't hesitate to reach out to us. And with that, I think we can go ahead and close out with our final slide, which is just a recap of what we do overall. Again, we've got a lot of financial expertise, but we do serve a whole host of industries. So this does give you a little profile of who we are as a firm. And with that, we are right at just 1 minute past, so we don't want to keep you all any longer. Thank you to our three speakers. Again, you all are a wealth of information, and I know it's always a joy to hear you speak, and I learned quite a bit. So I am sure our webinar guests have as well. Thank you all, and thank you to everyone who's joined us today. We appreciate it. We'll keep you posted on more webinars. You'll receive materials, follow-up materials tomorrow, and we hope you enjoy the rest of your day.
Bye, everyone. Thank you for coming.
Bye, everyone.